Hi, and welcome to this week's market presentation. Latest news. In the latest news regarding the war in Iran, negotiations between the US and Iran have so far failed to produce a negotiated end to the conflict. In the meantime, transit through the strait continues to be effectively blocked, removing roughly 20% of global crude oil supply, as well as roughly 20% of global LNG supply, equivalent to around 3% of global natural gas consumption per year. Over the past week, the US has continued to increase its military presence in the region, bringing additional assets and personnel in what some are warning could be signs that the US is prepared to escalate the conflict once again in order to get its victory. At the same time, Tehran continues to assert its control over the Strait of Hormuz. The end to the conflict could very well depend on which side ends up feeling more of the negative impact because of the closure of the Strait of Hormuz. Iran, who is rapidly approaching its onshore crude storage capacity limits, is feeling the pressure at the moment and has sent a new peace proposal to the US, which was reported to be described as insufficient by President Trump. At the same time, President Trump and the US are certainly feeling the pressure from the volatility in energy markets, especially when it comes to the price of crude oil, which reached a 4-year high last week, with Brent reaching over $126 a barrel before closing at the end of the week at $109 a barrel. The US has stated that it will be attempting to enforce, quote, freedom of navigation for commercial shipping through the Strait of Hormuz, but it remains unclear whether that will entail the use of US Navy vessels to enforce such freedom of navigation. Overall, equity markets remain optimistic that an end to the war is coming, even if there is virtually no traffic right now through the strait. Lastly, gas and coal prices are following oil to some extent, which is still much more impacted. Over the past week as well, tensions between the US and Europe are once again on the rise. President Trump announced a 25% tariff on European car imports due to the EU not complying with last year's trade deal. At the same time, the US has announced that it will be withdrawing 5,000 troops from Germany, with threats of similar withdrawals from countries such as Italy and Spain, as part of the US's feeling that NATO members have not been as accommodating and helpful regarding the war in Iran and as the US would have liked them to be. Overall, tensions between the European Union and the US right now taking place at a precarious moment given the conflicts in the Middle East, but also with Russia in Ukraine. Renewed trade war concerns between the two economies are coming at a time when inflation is already on the rise due to the war in Iran, and as slower GDP growth was already dampening the economic outlook, particularly for the euro area. The European Central Bank was seen as hawkish and ready to raise interest rates last week before holding them at 2%. Weather. Moving towards weather forecasts, weather conditions across Europe forecasted to remain mild over the next 7 to 10 days, with temperatures flirting between slightly above and below the seasonal averages for this time of year. Precipitation is forecasted to pick up across Europe for the next 7 to 10 days in a welcome sign for hydro storage levels. Lastly, over in terms of average wind speeds, while the beginning of this week will see relatively lower wind speeds, that's expected to change early next week with slightly higher wind speeds. Macroeconomics. Looking at the latest macroeconomic indicators, we see manufacturing PMI figures for the euro area, the US, and China. For the euro area, we see a relatively stable evolution over the month of April, while the US saw a more notable uptick in the manufacturing sector's PMI, going up to 54.5. China, on the other hand, remained at a pretty stable manufacturing PMI of just a little over 50 points. In terms of inflation, Japanese inflation for the month of March remained relatively stable, slight upside as seen in the year-over-year inflation rate up to 1.5%. Interesting to see what that is, especially for the month of April, and in case we'll see an additional impact from the war in Iran and the impact of rising energy prices.
Crude oil and LPG.
Looking towards crude oil markets next, we see that bullish price evolution for both Brent and West Texas crude over the past week, and the very high levels of volatility that we also see in the market with that surge in the price level last week before a slight easing at the end of the week. Overall, crude oil markets continue to feel the pressure from the fact that 20% of global supplies remain blocked behind the Strait of Hormuz. Refined products are facing similarly strong pressure as well, with concerns over the physical flow to those refineries.
Natural gas.
Moving towards natural gas prices in Europe remaining more stable over the past week. On the one hand, we do see some increasing correlation with spiking oil prices, while in terms of the European supply, we particularly see not just the impact of lower LNG imports, but also Norwegian maintenance adding some pressure to particularly short-term pricing. Looking towards storage levels have been increasing consistently over the last few weeks, now just around 33% full. And while we are looking at storage levels below last year's levels and below the average since 2012, the improved supply and demand balance due to weather conditions have continued to allow for injections to remain in positive territory. Overall, total supply remains at the lowest levels over the past 5 years, but fortunately, as total demand has eased even further, it has helped maintain that positive balance. Injections over the past week are now just slightly above the average since 2012, although still right now below the highs that we saw in 2025. In terms of the supply mix for natural gas, we can definitely see the downward trend when it comes to LNG sendouts, now going from the highest levels over the past 5 years before the war started to now just around the past 5-year average. For Norwegian gas flows, the maintenance season has already seen reductions in flows into Europe, pushing them near the lowest levels over the past 5 years, and it's really the lowest levels since last year's maintenance season in the fall. LNG imports into Europe have been gradually decreasing since the start of the war from a record high to just around the same level as the past 5-year average. World LNG exports have seen a slight uptick over the last couple of weeks, but nonetheless remained very much impacted by the war in Iran. Asian consumers, which were more directly impacted by the halt of physical flows from the Middle East, continue to be paying a higher premium than European consumers in order to secure those LNG imports. Investment funds remain bullish when it comes to natural gas prices in Europe, with the level of net long positions in the market dominating positions at the moment.
Coal.
Looking towards coal markets, coal prices saw an uptick in the price level, similar to what we saw with crude oil. When it comes to coal prices globally, a big factor adding support on the demand side of things has been the level of gas to coal switching that we're seeing in Asia. China in particularly has been increasing its share of coal in its power mix at the expense of natural gas-fired power generation, and that has helped ease the demand for LNG imports by China, which are now at a 3-year low. Coal prices in Europe are similarly finding support from the additional coal demand from the power sector. On the supply side of things, for the moment, supply, while certainly tighter due to the increase in demand, remains ample for this time of year.
EU and UK emission allowances.
Moving towards carbon allowances. Carbon allowances seeing a slight decrease in the price level over the past week. The decrease on the European side of things, in part driven by reports that the European Commission is serious about trying to curb the high prices of carbon as it negatively impacts the industrial manufacturing sector. But more importantly, we could be seeing signs of the potential demand destruction that we could see in Europe, or at least the slower economic growth that we could see this year as a result of the higher energy prices we currently have due to the war in Iran. On the other hand, latest reporting regarding the European Union proposals to adjust the ETS market are showing that we're not likely to see impacts to the carbon market for 2026, removing some of the bearish pressure on the market. For the UK side of things, as we've been saying over the last few months, the ongoing discussions to relinking the EU and UK carbon markets, adding support to UK carbon allowances. Emissions over the past week remain at the bottom of the range over the past 5 years. However, as we head into the summer, if we continue to see such high gas prices and the ensuing gas to coal switching, we could certainly see stronger power sector emissions this year versus last year. Lastly, investment funds for carbon allowances remained more on the long position side of things, with net long positions in both the EU and UK markets.
Electricity.
Electricity markets in Europe saw a limited movement over the past week. On the one hand, the uptick in natural gas prices, especially in the short term, adding support to electricity prices. On the other hand, the decrease in carbon allowances, easing some of the pressure on the market as well. The price evolution was quite similar across most European markets, especially over Central and Western Europe. Looking at total demand and residual load, total demand for electricity in line with the past 5-year average, while residual load has seen further decreases week over week as we continue to see strong renewable power generation. French nuclear power output remaining at the highest levels over the last 3 years, and notably above the past 5-year average. For renewables, while we did see a slight decrease over the last few days, overall renewable output remains at a record high for this time of year. One of the main reasons why we're seeing fossil generation at the lowest levels over the past 5 years, easing pressure on power sector demand for gas as well. Looking at renewable power generation, we see the record high levels of solar power output significantly above last year's levels. The very strong performance for solar power generation is compensating for the weaker performance, particularly from hydro, but also out of wind generation at times. For fossil fuels, we've seen a further decrease in fossil gas generation, now once again at the bottom of the past 5-year range. Coal power generation still at the bottom of the range, again, given the more limited demand for fossil fuel power generation over the past week. Although, again, the decreases in coal would be more pronounced if it wasn't for the gas to coal switching that we noted earlier. Lastly, looking at guarantees of origin, we've seen the bullish evolution continue over the past week, with prices now having rebounded sharply versus a month ago. Overall, for guarantees of origin, we're not only seeing increases in expected demand as a result of the growth in data centers and demand for guarantees of origin. On the supply side is where much of the bullish sentiment is also coming from, with the slower growth in renewable power generation year over year, particularly from hydro power generation, weighing on markets as well. That covers this week's market presentation. Thank you for joining.